So, to follow up on our discussion on financial statements, we looked at the Yellow Pad Company, and we can see that we have a number of accounts here: revenues and expenses, we have assets, liabilities, and equity. Okay, and we talked about this during class and on the previous recording about these different accounts and what they mean and so on. So when you have sales revenue, what it means is that you're selling a good, a product. If you're just providing a service, you wouldn't call it sales revenue. You'd probably call it service revenue or something of that nature. You would also not have cost of goods sold, because cost of goods sold indicates you're selling a product. So if you mow lawns for a living, you're not selling a product, so you wouldn't have cost of goods sold. So this company is selling a product, and that's why they have cost of goods sold. Now, we learned before that revenues and expenses need to go onto the income statement. So if we go below here, and I know in class we use the bigger ones, the bigger printouts, but for now what we're going to do is we're going to use these smaller ones that are available right here, just to make it easier to see the numbers. So when we have an income statement, generally what we have is we have two columns. Now, there is some variation in this. You could have one column, you could even have three columns, depending on how complicated your income statement is. This column is known as a addition column, so it's where we can do calculations. This column is known as a total column. So we're going to start off with our sales revenue. Okay? Remember, revenues and expenses go on the income statement. So our sales revenue is $950,000, and we have cost of goods sold of $570. I'm sorry, $380. Okay, $380. So one of the things any merchandiser would want to know is, how much did I earn just from selling my product? Okay, because that's my primary revenue. So I want to know, I want this intermediate step to say, okay, what did I earn just selling my product? That's called gross profit. Okay, so sales minus cost of goods sold is called gross profit. Okay, gross profit. So what we can do is we can take our sales, and don't worry about the Excel stuff right now. We'll probably go over that at a later time. Okay, but we're taking our sales minus our cost of goods sold, and that's giving us a gross profit of $570,000. Now, I have to use that to put towards my regular old operating expenses like wages, supplies, delivery, etc. One of the things that an investor or a creditor might want to know is, what is your gross profit percentage? In other words, out of every dollar in sales of your product, how much could you keep before expenses? Okay, so that's gross profit percentage. So how much do I keep in from each dollar of sales to put toward my expenses? Okay, and the way I'm going to do this is I'm just going to take my gross profit, and I'm going to divide it by sales. Sales revenue. So my gross profit percentage here is going to be pretty good, probably. So I take my $570,000 and divide it by the $950,000. Okay, on Excel you have to use the backslash to divide, but I don't want you to get hung up on the Excel right now. Okay, So the 570 divided by the 950 gives us a gross profit percentage of 60%. So out of every dollar in sales, okay, I get to keep 60 cents to put towards my expenses. Okay, so this is a short way for an investor or creditor to look at this and get an idea of where you are. Now, my expenses, okay, are all of these things: the wages, the supplies, the delivery, etc. Okay, so I'm just going to copy these down. Okay. And again, don't worry about all these Excel functions. Okay, that's something we could work on another time. Okay, but just to show you that all of these, okay, all right, are considered to be your operating expenses or your regular expenses. So if we total our expenses, we get $300,500. So this company has net income, right? And when I have sales, when I sell a product, and I have gross profit, to calculate my net income, what I have to do is take my gross profit minus my operating expenses. Now, we're not worried about taxes right now. That's a whole nother issue. Okay, but in order for me to calculate my net income here, I have to take the 570,000, right, minus the 300,500. And what that's going to do is that's going to tell me what my net income is. Okay, all right. So this company has net income of $269,500. So they were profitable for 2021. Okay, so that's a very important number for anybody that's going to make financial decisions for this company to know. Okay, not only the people that are running the company, but also all the other users of accounting information, like government, like investors, creditors, etc. And if you're the business owner, you want to know that you're making a profit. Otherwise, why are you doing it? I mean, you might love doing it, but you have to make a profit to continue. So in order to get my profit margin ratio, okay, what I have to do is I have to take my net income and divide it by sales revenue. And what you're doing here is you're saying in every dollar of revenue, what do I keep? So in other words, in every dollar in revenue that I earn, whether it's through a sale, selling a good, or a service, okay, you want to know what you get to keep, because you want to say, okay, am I profitable? What kind of return am I getting on the work I'm doing and the revenue I'm getting? Because if I'm not earning enough, then maybe I need to make another decision, right? So this is really important. In economics, there's an item called opportunity cost, where I look at what's the best alternative I've given up. If you're running a business full-time, what are you giving up? A job, right? So if you can find a job that makes more than this, or at least a higher percentage of your return, you would probably do that instead. So here what we have to do is take the 269,500 and divide it by the 570. So we end up with, I'm sorry, not the 570, the 950. 950. So we end up with 28%. So out of every dollar you're earning, you get to keep 28 cents. So that's a very good return on what you're earning. So it'd be hard to earn that much on anything else. So we could say this business had a pretty successful first year, and we're assuming this is their first year. Okay, so So for every dollar they've earned, they get to keep 28 cents. So it's cost them 72 cents to earn a dollar. Okay. All right, so that's good. Now, in order to do the statement of owner's equity, in the class we put owner's capital in the date. Here I have ending capital. It doesn't really matter that much. Okay, but we know the beginning capital for the owner was 0. So they were able to start the company with no investment or no out-of-pocket costs, apparently. Okay, they had net income of $269,500. So net income, of course, is going to increase the owner's equity, right? It's going to have a positive impact on the owner's stake in the business, right? Now, if the owner takes out withdrawals, okay, takes money out for personal use, that's going to reduce their equity in the business, right? It's going to, reduce their stake in the business. It's going to reduce its value. So in order for me to figure out the increase in capital, I simply need to take the net income. Since we have nothing that we started with, I'll just take the net income and subtract the withdrawals. Okay, so because remember, the withdrawals, even though the law sees it as, just two different piles of your money, from an accounting standpoint and from the entity concept, we're saying in order to get a true look at the financial condition of the business, we need to recognize that you're taking that $45,000 away from the business. Okay, so your increase in capital was $224,500. Since you started with nothing, that's your ending capital. Okay, so we're going to do the balance sheet in the next class, and I will also do a recording on that. So thank you again for your attention.